Welcome to the Deep Dive. Today we're tackling something foundational, but let's be honest, often a bit opaque in financial planning: trusts. For advisors managing client wealth, especially thinking about generations, estate transfers, or just protecting assets, trusts are pretty much unavoidable. They sound technical, maybe a bit dense with tax rules, but they are incredibly powerful tools. So our mission today is simple. We want to pull out that core working knowledge of trusts, how they operate, and crucially, how they're taxed that you really need as an effective advisor. It's about spotting the structure, understanding its purpose, not necessarily drafting the legal docs yourself.
That's a really key distinction, yeah. I mean, at its heart, a trust is just a legal setup. It separates the legal ownership of an asset from, well, who actually benefits from it. You have a settlor putting assets in, then you have trustees managing those assets according to the rules, all for the beneficiaries. Simple concept, complex execution sometimes.
Okay, so if we're not drafting the documents, why is this understanding so vital? Why is it non-negotiable for a modern advisor? What problems are we actually solving here?
Well, it really boils down to three things: control, capacity, and protection. Fundamentally, trusts are there to shield assets. Think divorce, creditors, maybe just poor financial decisions down the line. They're also essential if you need to support vulnerable beneficiaries, people who might not be able to manage their own finances effectively. And, maybe most importantly for long-term planning, they let a client control how wealth is distributed long after they're gone, across generations even. So, the advisor's value isn't the legal nitty-gritty. That's for the solicitors, definitely. Your role is more about identification, spotting the sign, the need for that protection, that generational control, and knowing enough about the pros, cons, and tax implications to say, okay, we need specialist advice here.
Right, that makes sense. Spot the need, understand the basics, then call in the experts. Okay, before we dive into the tax side, which I know can get complicated, we need to grasp the basic mechanics. Can we map out those three main types we see most often in the UK? Starting with the simplest.
Absolutely. Let's start with the bare trust. It's really the most straightforward type. Here, the beneficiary has an immediate, absolute right, both to the income the assets generate and to the capital itself.
So just checking, I've got this right. With a bare trust, the beneficiary is basically the owner already, just maybe waiting until they hit a certain age to actually take control.
Exactly that. Very common for making gifts to children or young adults. And that ownership right is key for tax. The gains, the income, it's all treated as belonging directly to the beneficiary, which, can be quite tax efficient if they've got unused personal allowances, potentially lower tax overall on the income generated.
Okay, simple enough. Moving up a step in complexity then, interest in possession trusts or IP trusts. This seems to introduce that split, doesn't it, between who gets the income and who gets the underlying asset?
It does, precisely. With an IP trust, you have one beneficiary, often called the life tenant, who has the right to all the income the assets produce, usually for their lifetime, but it could be a set period. But crucially, the trustees hang on to control of the capital, the actual asset itself. You see these a lot in estate planning, particularly with blended families. It's a common scenario. For instance, a client might use one in their will, ensure their current spouse gets an income for life, but then guarantee the capital passes to their own children from a previous relationship eventually. The tax treatment here gets a bit more nuanced, though. It really depends on whether the trust was set up during the settlor's lifetime or established on their death through a will.
Right, okay. Lifetime versus death makes a difference. Now let's get to the one that gives trustees the most power, but also brings the most complexity, the discretionary trust. Here, the trustees have full flexibility, is that right?
Complete flexibility. That's the defining feature. The trustees have the discretion to decide who benefits from the pool of potential beneficiaries, who gets income, who gets capital, when do they get it, how much. It's really the ultimate tool if you need maximum control over long-term family wealth, or if you need to protect beneficiaries who might be particularly vulnerable or perhaps not great with money.
But that huge amount of control comes at a price, doesn't it? Especially when we talk about inheritance tax. Can you walk us through the IHT structure for these? It sounds significant.
Yes. This is where discretionary trusts really stand apart for IHT. They typically fall under what's called the relevant property regime. And this regime has potentially three key IHT trigger points. First, there can be an entry charge IHT might be due when assets go into the trust during the settlor's lifetime. Depends on the value, of course. Second, and this is the one people often focus on, the periodic charges. This is a potential IHT hit every 10 years on the value of the assets still held in the trust. And third, exit charges. These can apply when assets are distributed out of the trust to a beneficiary.
Hold on. So Potentially tax going in, tax every 10 years just for existing, and tax coming out. Plus, as we'll get to, potentially less favorable income and CGT rates inside. Why would anyone opt for this level of tax complexity and potential ongoing cost?
It comes back to those non-tax reasons. Control and protection. It's that ultimate safety net. If you're worried about an inheritance being squandered, or maybe future unforeseen circumstances for a beneficiary like a disability, divorce, creditors coming knocking, that level of trustee control offered by a discretionary trust is unmatched. The IHT burden is often seen as the trade-off, the price you pay for that maximum protection and flexibility over decades.
Okay, that trade-off makes sense now. Control versus tax cost. Let's pivot properly to the tax then, high level. Because these differences are crucial for the client's overall picture. Trustees are treated differently to individuals, right?
Oh, very differently. Absolutely. If we look at income tax first, trustees usually pay tax at specific trust rates on any income they hold on to that they don't distribute. And these rates are often set deliberately higher than personal rates. It's partly an anti-avoidance thing, to discourage people just parking income in trust to avoid their own higher personal tax rates. But, and this is important for advisors, if the trustees do distribute that income to a beneficiary, then it's the beneficiary who's taxed on it. And depending on their own tax situation, they might actually be able to reclaim some or all of the tax the trust originally paid. So there can be planning opportunities there, but it needs careful management.
And that same kind of disparity exists for capital gains tax too, doesn't it? Lower allowances, higher rates for trusts compared to individuals.
Fundamentally, yes. Trusts get a much, much smaller annual exempt amount for CGT compared to an individual, often half or even less depending on the circumstances. And any gains above that small allowance, typically taxed at the highest CGT rate. So straight away, it's less efficient purely for capital growth compared to holding assets personally, unless those other benefits like protection are paramount. But the real trap here, the thing advisors must flag, is the transfer into the trust. Simply moving an asset into, say, a discretionary trust can be treated as a disposal at market value for CGT purposes. That could trigger an immediate tax bill right there and then. You need to know that this risk exists because the way to potentially avoid that immediate hit is claiming something called holdover relief. Just knowing that term, holdover relief, and understanding it might apply is the crucial flag. It signals the absolute need for specialist tax advice before any transfer happens.
That's a critical point, tax when setting up versus tax during operation. So bringing this back to estate planning and those IHT periodic charges, what determines if a trust falls into that complex relevant property regime or not?
It all hangs on the IHT classification. Broadly speaking, bare trusts are simple. They're outside the relevant property regime, the RPR, because HMRC sees the assets as already belonging to the beneficiary. Similarly, certain interest in possession trusts, specifically those created on death via a will, can also fall outside the RPR. And if they're outside, no periodic charges, no exit charges, much simpler from an IHT perspective. But the moment a trust gives the trustees that full flexibility over who gets what and when, essentially the discretionary trust, it almost always falls inside the RPR. Being inside means the assets are considered relevant property, and that directly subjects the trust to potential lifetime charges, those 10-year periodic charges, and the exit charges. That's why managing a discretionary trust involves factoring in that potential IHT cost every single decade.
Right. So discretionary usually means relevant property regime, which means ongoing IHT considerations. Got it. Given all this, where do advisors most commonly encounter trusts in everyday financial planning? Where are you likely seeing these structures today?
The absolute most frequent one has to be life insurance planning. Writing life policies in trust. It's not just a nice to have, it's really essential best practice. Why? Because putting the policy in trust means the payout on death normally goes straight to the beneficiaries, bypassing probate, faster access to funds, and crucially, the payout is usually outside the deceased estate for inheritance tax. So it doesn't increase the IHT bill. Advisors handle these simple trust forms all the time. The second big area is pensions. Many modern pension schemes, especially for death benefits, operate effectively under a discretionary trust structure built into the scheme rules. This offers really valuable IHT advantages. But as an advisor, you need to understand how the client's expression of wish or nomination form guides the pension scheme trustees when they decide who gets the death benefits. It influences, but doesn't always bind, their decision.
Okay, so life policies and pension death benefits are key areas. And when dealing with any trust, even just reviewing investments held within one, that initial fact-finding stage is absolutely critical, isn't it?
Oh, totally critical. You have to look beyond just the assets held. You need the details. What was the trust set up for originally? What beneficiaries are named? But critically, what powers do the trustees actually have according to the trust deed? Can they invest freely? Can they appoint investment managers? What are the rules around distributing income versus capital? Any advice you give on investment strategy must fit within the legal powers granted by that trust document. Otherwise, you could inadvertently advise the trustees to act outside their authority, which is a serious issue.
And that leads us neatly to the final point, drawing that clear line. What's the advisor's responsibility when it comes to compliance and knowing when to refer on?
You absolutely have to know when compliance issues are triggered. A major one right now is the Trust Registration Service, or TRS. Many trusts, not just new ones, now have a legal requirement to be registered with HMRC via the TRS and keep that information updated. It's complex, it's mandatory for the trustees, and there are penalties for getting it wrong. So the non-negotiable rule for the advisor is this. The moment questions arise about compliance deadlines like TRS, specific tax calculations for the trust, or detailed legal reporting, that must be referred immediately to a specialist. A solicitor, a tax accountant who deals with trusts. Your highest value here isn't knowing the TRS deadline offhand, it's spotting the type of trust, recognizing it likely needs registration or has complex tax ongoing, and efficiently connecting the client to the right specialist support to handle it properly. Protecting the client, basically.
So wrapping this up then, if our mission was to find that essential working knowledge, it seems the advisor's key role isn't being a tax or legal expert on trusts. It's about being able to confidently identify the main structures, bear, IP, discretionary, understanding the core trade-offs, especially around control versus tax complexity, and crucially, recognizing those red flags, the potential for ongoing IHT charges with relevant property, the need for things like TRS registration, and knowing when to insist on bringing in specialist help.
Exactly. That recognition, that ability to see how the trust fits into the client's bigger picture and when it triggers specific needs, that's what elevates planning beyond just recommending products. It ensures the whole structure works correctly and compliantly.
Which leaves us with a final thought for you, the listener, to take away. Think about how common trust language is in standard documents, like those life insurance trust forms we mentioned or pension nomination paperwork, and now consider the TRS registration rules for many IP and discretionary trusts. How many of your clients might, perhaps unintentionally, be trustees or beneficiaries of a trust structure without fully grasping the ongoing duties, especially around compliance? Which existing client files might be worth revisiting today just to double-check their trust documentation is complete, understood, and fully compliant? Something to think about. We'll catch you on the next deep dive.